Let me tell you about the four largest bets I am making right now with my own money. These are not speculative gambles. These are not hot tips I heard at a dinner party. These are concentrated positions that represent my highest conviction ideas after spending thousands of hours analyzing businesses, studying industries, and thinking about where the world is heading over the next decade. I want to be completely transparent with you about something when I make a big bet. I am not just putting capital at risk. I am putting my reputation at risk. I am putting my track record at risk. I am putting everything I have built over 25 years on the line. So when I tell you I am betting big on these four companies, understand that I have done the work. I have stress tested every assumption. I have considered everything that could go wrong. And I still believe these are among the best risk-adjusted opportunities available in the market today. The philosophy behind concentrated investing is controversial. Most financial advisors will tell you to diversify, spread your money across dozens or hundreds of stocks, reduce your risk by never having too much in any single position. And for most people, that is probably good advice. If you do not have the time or expertise to analyze businesses deeply, broad diversification protects you from your own ignorance. But I am not most people. And if you are watching this, you probably are not either. You want to understand how wealth is actually created, not slowly and incrementally through index funds, but dramatically through concentrated bets on exceptional businesses. That is how every great fortune in history has been built. Not through diversification, but through concentration. The key to concentration is conviction. And conviction comes from understanding. When you truly understand a business, when you know its competitive advantages, its growth drivers, its risks, its management, its valuation, you can have the confidence to bet big. Without that understanding, concentration is just gambling. With it, concentration is the fastest path to building serious wealth. So let me walk you through these four companies and explain exactly why I am betting big on each one. I am going to give you the full thesis, not a superficial overview. By the end, you will understand these businesses as well as I do. And you can decide for yourself whether they deserve a place in your portfolio. The first company I am betting big on is Universal Music Group. This might surprise you because most people think of music as a declining industry. They remember Napster destroying the record business in the 2000s. They remember artists complaining about streaming payouts. They see music as a commodity that technology has devalued. But I see something completely different. I see an industry that has been transformed by streaming into one of the most attractive business models in the world. And I see Universal Music Group as the dominant player in that industry with competitive advantages that are essentially permanent. Let me explain the transformation that has happened. In the old days, the music industry made money by selling physical products, CDs, cassettes, vinyl records. The problem with physical products is that they can be copied. Once digital files existed, anyone could copy and share music for free. The industry collapsed. Revenue fell by more than half from its peak. Then streaming emerged. Spotify, Apple Music, Amazon Music, YouTube Music. Instead of buying individual albums, consumers pay a monthly subscription for access to all music. This model has completely changed the economics of the industry. Here is what most people miss. Streaming is not just a new distribution method. It is a fundamentally better business model than physical sales ever were. With physical sales, you had hits and misses. An album either sold millions of copies or it flopped. Revenue was lumpy and unpredictable. With streaming, every song ever recorded generates revenue every time someone listens to it. The entire catalog becomes valuable, not just new releases. Universal Music Group owns the largest music catalog in the world. They own the Beatles. They own Taylor Swift's early albums. They own Drake, Billie Eilish, The Weeknd, Post Malone, and hundreds of other current artists. They own decades of classic rock, jazz, country, hip-hop, every genre you can imagine. This catalog is irreplaceable. You cannot go back in time and sign the Beatles. You cannot recreate Abbey Road or Thriller or any of the other albums that define musical history. The catalog generates royalties every single day as people stream music around the world. And here is the beautiful part. The costs to maintain that catalog are essentially zero. The music was recorded decades ago. The artists were paid, the production costs are sunk. Every dollar of streaming revenue from catalog music flows almost entirely to profit. But Universal is not just a catalog company. They continue to sign and develop the biggest new artists in the world. Their A&R team, the people who discover and sign talent, is the best in the industry. They have relationships with managers, agents, and producers that give them first access to emerging artists. When a new star emerges, Universal is usually the one signing them. The growth drivers for Universal are powerful and durable. Streaming penetration is still relatively low globally. Hundreds of millions of people in Asia, Africa, and Latin America are just starting to get smartphones and internet access. As they come online, they will subscribe to music streaming services. The addressable market is growing every year. Pricing power is another underappreciated driver. Spotify and Apple Music have started raising subscription prices, and churn has been minimal. Consumers are willing to pay more for music because the value proposition is so strong. Unlimited access to every song ever recorded for the price of one CD per month. As prices rise, Universal's royalty revenue rises. Proportionally, new monetization channels are emerging constantly. Social media platforms like TikTok and Instagram pay licensing fees to use music. Fitness apps, meditation apps, gaming companies, they all need music and they all pay royalties. The ways that music gets used and monetized keep expanding. The valuation of Universal Music Group is reasonable for a business of this quality. You are paying a fair multiple for a company with irreplaceable assets, recurring revenue, high margins, and multiple growth drivers. This is not a speculative bet on something that might work. This is a bet on a proven business model with dominant competitive position. I believe Universal Music Group will compound at attractive rates for the next decade or more. The music industry has been reborn through streaming, and Universal is the biggest winner. There is another dimension to the Universal story that most investors miss entirely. Music is becoming more valuable as a cultural force, not less. Think about how music permeates every aspect of modern life. It is the soundtrack to TikTok videos that go viral. It is the background in every television show, movie, and advertisement. It is what people listen to while working out, commuting, relaxing, and everything in between. Music has never been more present in daily life. This ubiquity translates directly into monetization opportunities. Every use of music creates a royalty payment. When a TikTok creator uses a song in a video, Universal gets paid. When a television show licenses a song for a scene, Universal gets paid. When a brand uses music in a commercial, Universal gets paid. The surface area for music monetization keeps expanding. Artificial intelligence actually presents an opportunity for Universal, rather than a threat. AI can create music, but consumers want authenticity. They want to listen to artists they connect with emotionally. AI-generated music might work for background applications, but the songs people love, the songs they play at weddings and funerals and celebrations, those will always be created by human artists. Universal owns the relationships with those artists. The second company I am betting big on is Chipotle Mexican Grill. Now I know what you might be thinking, a restaurant company in this economy, with all the challenges facing the restaurant industry. But Chipotle is not a typical restaurant company. It is one of the most extraordinary growth stories in American business, and I believe the best is yet to come. Let me explain what makes Chipotle special. Most restaurant companies are franchised. They license their brand to independent operators who actually run the restaurants. This model has advantages, but it also means the parent company has limited control over quality and customer experience. Chipotle is different. They own and operate every single restaurant themselves. This gives them complete control over ingredients, preparation, service, and the overall experience. That control has allowed Chipotle to build something rare in the restaurant industry. Genuine brand loyalty based on product quality. People do not go to Chipotle because it is cheap. They go because the food is actually good. Real ingredients prepared fresh in front of you. customized exactly how you want it. In a world of processed fast food, Chipotle offers something different. The unit economics of Chipotle restaurants are exceptional. A typical location generates about $3 million in annual revenue, with restaurant-level margins of 25 to 27%. That is extraordinarily high for the restaurant industry. It means each restaurant generates $700,000 to $800,000 in annual cash flow, and it costs only about $1 million to build a new restaurant. So the payback period is less than 2 years. With economics like that, growth is essentially self-funding. Chipotle can build new restaurants using the cash flow from existing restaurants without taking on debt or issuing shares. This is exactly the kind of compounding machine I look for as an investor. The growth runway is enormous. Chipotle currently has about 3,400 restaurants in North America. Management believes they can eventually have 7,000 or more in the US alone. That is more than a doubling of the store base. And they are just beginning international expansion, which could add thousands more locations over time. Each new restaurant is highly profitable from day one because the Chipotle brand is so strong. When they open in a new market, customers already know what to expect. There is no expensive marketing required to build awareness. People line up on opening day because they have been waiting for Chipotle to arrive. The digital transformation at Chipotle has been remarkable and underappreciated. Over 40% of sales now come through digital channels, either through the app, the website, or delivery platforms. Digital orders have higher average tickets because customers spend more time browsing the menu, and the data from digital orders allows Chipotle to personalize marketing and improve operations. The Chipotlane concept, a drive-through lane specifically for picking up digital orders, is a game changer. It combines the convenience of drive-through with the customization of the Chipotle experience. New restaurants with Chipotlanes are generating significantly higher sales than traditional formats. As Chipotle builds more of these locations, average unit volumes will continue to rise. Menu innovation provides another growth lever. Chipotle has historically had a very limited menu, which is part of what makes their operation so efficient. But they are carefully testing new items like quesadillas and new proteins that can drive incremental visits without complicating operations. Each successful new item adds to same-store sales growth. The management team at Chipotle is excellent. Brian Niccol, who recently left to run Starbucks, transformed the company during his tenure. The new leadership team is continuing his playbook of digital innovation, operational excellence, and disciplined growth. I have confidence they will execute well. The valuation of Chipotle reflects its quality. So this is not a deep value investment, but I believe the growth ahead justifies the premium. When a company can grow earnings at 20% or more annually for the next decade, while generating high returns on capital, you can pay a full price and still do very well. I want to address the concerns some investors have about Chipotle. Labor costs are rising, and restaurants are labor-intensive businesses. This is true, but Chipotle has advantages here too. Their simplified menu and efficient kitchen design require fewer employees per dollar of revenue than most competitors. They invest heavily in training and retention, which reduces costly turnover, and their strong unit economics give them room to absorb higher wages while maintaining attractive margins. Competition is another concern. Every fast casual chain wants to replicate what Chipotle has built, but replicating Chipotle is much harder than it looks. The consistency of the product across thousands of locations, the supply chain that sources high-quality ingredients at scale, the brand positioning that commands premium prices. These things took decades to build and cannot be copied overnight. Food safety incidents have hurt Chipotle in the past, and could again. This is a real risk I take seriously. But the company has invested hundreds of millions of dollars in food safety improvements since the incidents in 2015 and 2016. Their protocols are now among the most rigorous in the industry. While no system is perfect, I believe the risk is manageable and already reflected in investor perceptions. The third company I am betting big on is Howard Hughes Holdings. This one requires more explanation because it is not a household name, but I believe it represents one of the most compelling opportunities in the entire market. Howard Hughes Holdings is a real estate company, but not a typical one. They do not own office buildings or shopping centers or apartment complexes in random locations. They own and develop master-planned communities, entire towns essentially, in some of the fastest-growing parts of the United States. Let me explain what a master-planned community is. These are large-scale developments where the company owns thousands of acres of raw land. They create a master plan for how the community will develop over decades. They install infrastructure like roads, utilities, and amenities. They sell land to home builders who construct houses. They build commercial properties like shopping centers, office buildings, and entertainment venues. They create parks, trails, schools, and everything else a community needs. The genius of this model is that Howard Hughes captures value at multiple stages of development. They buy raw land cheaply, often decades before it will be developed. They add value through planning and infrastructure. They sell residential land to builders at a profit. They retain commercial land and develop income-producing properties. And as the community grows and becomes more desirable, the value of remaining land increases. The communities Howard Hughes owns are in exceptional locations: Summerlin in Las Vegas, The Woodlands in Houston, Bridgeland, also in Houston, Ward Village in Honolulu, Columbia in Maryland. These are not random suburban developments. These are premier communities that attract affluent residents and command premium prices. The demand drivers for these communities are powerful. Americans continue to migrate from high-cost, high-tax states to lower-cost states like Texas, Nevada, and Florida. Remote work has accelerated this trend because people can now live wherever they want while working for companies anywhere. The communities Howard Hughes owns are direct beneficiaries of these migration patterns. Here is what makes Howard Hughes so interesting as an investment. The company trades at a massive discount to the value of its assets. When I analyze the land holdings, the income-producing properties, and the development pipeline, I calculate a net asset value significantly higher than the current stock price. You are buying dollars for 50 or 60 cents. Why does this discount exist? Several reasons. The company has been poorly covered by Wall Street analysts who do not understand the master-planned community model. The stock is relatively illiquid, which keeps large institutions away. The previous management team made some mistakes that frustrated investors, and real estate in general has been out of favor due to higher interest rates. But things are changing. The company has new leadership that is focused on simplifying the business and highlighting the value. They are selling non-core assets and returning capital to shareholders. They are improving disclosure, so investors can better understand what they own. These actions should help close the gap between the stock price and intrinsic value. Even if the discount never closes, Howard Hughes is a good investment because of the underlying growth in community values. As these master plan communities mature and fill in, the land becomes more valuable. The commercial properties generate more income, and the company creates value for shareholders. The discount closing would be a bonus on top of that fundamental value creation. I view Howard Hughes as a situation where I get paid to wait. The assets are real and valuable. The discount provides a margin of safety, and multiple catalysts could cause the market to recognize the value. In the meantime, the communities keep growing and the intrinsic value keeps compounding. Let me give you a concrete example of how value creation works at Howard Hughes in the Woodlands. They might buy raw land for $10,000 per acre decades before it will be developed. They install roads, utilities, and amenities. They create zoning that allows residential and commercial development. When home builders are ready to construct houses, Howard Hughes sells them fully entitled land for $100,000 per acre or more. That is a 10 times increase in value, and it happens over and over across their communities. Then they retain the commercial land and develop shopping centers, office buildings, and other properties that generate ongoing rental income. A piece of land they paid $10,000 for might eventually support a commercial property worth millions. The value creation is extraordinary when you own the land early and control the development process. The time horizon for this value creation is measured in decades, which is why most investors overlook Howard Hughes. Wall Street wants stocks that will work in the next quarter or the next year. They do not have the patience for investments that compound over 10 or 20 or 30 years. But that long time horizon is exactly what creates the opportunity for patient investors like me. The fourth company I am betting big on is Alphabet, the parent company of Google. Now, Alphabet is not an obscure or overlooked company. It is one of the largest in the world. So why is it on my list of big bets? Because I believe Alphabet is dramatically undervalued relative to its competitive position and growth prospects. The market is worried about artificial intelligence disrupting Google search. I think those fears are overblown. And I think AI will ultimately strengthen Google rather than weaken it. Let me explain my thinking. Google Search has been the dominant search engine for over 2 decades. They have approximately 90% market share globally. Every day, billions of people go to Google when they want to find something. This behavior is so deeply ingrained that Google has become a verb. That level of market dominance and brand recognition is almost impossible to displace. The bear case on Google is that AI chatbots like ChatGPT will replace traditional search. Instead of typing a query into Google and clicking through links, people will just ask an AI assistant and get a direct answer. If this happens at scale, Google's search advertising business could be disrupted. I think this fear is exaggerated for several reasons. First, Google is not standing still. They have been investing in AI for over a decade. They own DeepMind, one of the leading AI research labs in the world. They created the transformer architecture that underlies all modern large language models. They have more AI talent, more data, and more computational resources than almost anyone. Google will have its own AI assistant that is competitive with or better than alternatives. Second, there are many searches where the traditional Google model works better than a chatbot. Shopping searches where you want to compare products and prices, local searches where you want to see maps and reviews, news searches where you want multiple sources and perspectives, research searches where you want to explore a topic in depth for these use cases. Clicking through curated links is often more useful than getting a single AI-generated answer. Third, even if AI changes how people interact with search, Google can adapt its business model. They can show ads alongside AI-generated answers. They can charge for premium AI features. They can use AI to make their existing advertising products more effective. Google has successfully navigated multiple technology transitions over the past 2 decades. I expect them to navigate this one as well. Beyond search, Alphabet has multiple other valuable businesses. YouTube is the dominant video platform globally with over 2 billion monthly users. It is the second largest search engine after Google itself. Advertising revenue continues growing as more video consumption shifts online and advertisers follow. Google Cloud is the third largest cloud computing platform behind Amazon and Microsoft. It is growing rapidly and approaching profitability. The cloud market is still early in its development with massive growth ahead, as more enterprises move workloads online. Waymo, their autonomous vehicle subsidiary, is the leader in self-driving technology. They operate commercial robotaxi services in multiple cities. The potential value of autonomous transportation is enormous if they can scale it successfully. Android is the dominant mobile operating system globally, giving Google strategic control over how billions of people access the internet on their phones. This drives traffic to Google services and provides valuable data for improving products. When I add up all of these businesses and apply reasonable valuations to each, I get a number significantly higher than where Alphabet trades today. The market is essentially giving you YouTube, Google Cloud, Waymo, and Android for free and valuing only the search business at a discount because of AI fears. The balance sheet is pristine. Alphabet has over $100 billion in cash and investments with minimal debt. They generate enormous free cash flow that they return to shareholders through buybacks. The company has bought back tens of billions of dollars of stock over the past few years at prices well below what I believe the company is worth. Management has become more shareholder-friendly in recent years. They are more focused on profitability. They are more disciplined about costs. They are more willing to return capital, rather than hoarding cash for speculative moonshot projects. This improved capital allocation makes the stock more attractive. I view Alphabet as a situation where the market is overweighting a risk that I believe is manageable, while underweighting the value of extraordinary assets in competitive positions. At current prices, you are getting one of the best businesses in the world at a meaningful discount to intrinsic value. Let me share some additional perspective on why I am confident about Alphabet's ability to navigate the AI transition. Google has been through technology transitions before. They successfully moved from desktop to mobile, when many predicted mobile search would disrupt them. They successfully built YouTube into a dominant platform, despite competition from numerous video startups. They successfully built a cloud business from scratch to compete with Amazon's head start. The company has a culture of innovation and a willingness to cannibalize its own products when necessary. That cultural DNA gives me confidence they will figure out how to integrate AI into their business model in ways that maintain and enhance their competitive position. I also think the regulatory environment for AI may actually benefit large established players like Google. As governments around the world develop AI regulations, compliance will become increasingly costly and complex. Large companies with legal and regulatory resources will navigate this better than startups. This could actually reinforce Google's competitive position rather than weakening it. The advertising business model that powers Google is also surprisingly resilient to AI disruption. Advertisers need to reach consumers. Consumers are on Google's platforms. That fundamental dynamic does not change just because the interface shifts from links to AI-generated responses. Google will find ways to monetize AI interactions just as they monetize traditional search. Now, let me step back and explain the common threads across these four investments. Understanding why I chose these specific companies will help you develop your own framework for identifying great investments. First, all four companies have durable competitive advantages that protect their profits from competition. Universal Music has its irreplaceable catalog and artist relationships. Chipotle has its brand, quality, and operational excellence. Howard Hughes has prime land in the best locations that cannot be replicated. Alphabet has its dominant market positions and massive scale advantages. These moats allow the companies to earn high returns on capital for extended periods. Second, all four companies have significant growth runways ahead of them. Universal benefits from global streaming adoption and new monetization channels. Chipotle can more than double its store count while growing same-store sales. Howard Hughes will realize value over decades as their communities develop. Alphabet continues growing through cloud, YouTube, and core search. Growth is the engine that compounds wealth over time, and all four companies have it. Third, all four companies have strong management teams that I trust to allocate capital wisely. This is crucial because even great businesses can be destroyed by bad management. In each case, I have confidence that the people running these companies understand what makes them special and will make decisions that create long-term shareholder value. Fourth, all four companies are available at reasonable valuations given their quality and growth. I am not paying speculative prices based on hope. I am paying fair prices based on current cash flows with significant upside, if growth continues as I expect. The combination of quality and reasonable valuation provides a margin of safety. Fifth, all four companies have specific catalysts that could unlock value over the near to medium term. Universal has pricing increases and new streaming markets. Chipotle has new restaurant openings and digital growth. Howard Hughes has asset sales and improved disclosure. Alphabet has potential resolution of AI fears and continued buybacks. Catalysts help ensure that intrinsic value gets reflected in stock prices. I want to address the concentration risk that comes with betting big on just a few companies. Yes, if one of these investments goes badly wrong, it will hurt my overall returns. But I believe concentration is appropriate when you have genuine conviction based on deep analysis. The risk of diversification is mediocrity. When you own 50 or 100 stocks, you inevitably include some mediocre businesses along with the good ones. Those mediocre businesses drag down your returns. You also cannot know all 50 companies as well as you can know 4. You spread your analytical resources too thin. The risk of concentration is being wrong about a specific company. But that risk can be mitigated through rigorous analysis, conservative assumptions, and position sizing. I never bet so big on any single idea that being wrong would be catastrophic. I maintain the ability to survive being wrong and keep playing the game. Over my career, my biggest wins have come from concentrated positions in my highest conviction ideas. The investments where I did the most work, developed the deepest understanding, and had the courage to bet big. Diversification would have reduced my returns dramatically because it would have diluted those winners with average performers. I want to leave you with a framework for thinking about your own investments. Ask yourself these questions about any company you are considering. Does this company have a durable competitive advantage that will protect its profits for years to come? If not, move on. Competition will erode returns over time. Does this company have significant growth ahead of it? If not, you are dependent on valuation expansion to make money, which is unreliable. Do you trust the management team to make good decisions with your capital? If not, even a great business can destroy value. Is the valuation reasonable given the quality and growth of the business? If not, you might be right about the company but still lose money because you overpaid. Are there specific catalysts that will cause the market to recognize the value? If not, you might have to wait a very long time to be proven right. If a company passes all 5 tests, it deserves consideration for a concentrated position. If it fails any of them, keep looking. The 4 companies I have discussed today all pass these tests: Universal Music Group, Chipotle, Howard Hughes Holdings, and Alphabet. These are the businesses I am betting big on with my own capital. These are the companies I believe will compound wealth at attractive rates for years to come. I am not giving you financial advice. I am sharing my thinking and my process. You need to do your own analysis, consider your own circumstances, and make your own decisions. But I hope this gives you a framework for thinking about concentrated investing and some specific ideas worth investigating further. Building wealth is not about finding secret tips or timing the market perfectly. It is about finding great businesses, understanding them deeply, buying them at reasonable prices, and having the patience to let them compound. That is what I am doing with these 4 companies. And that is what I believe will generate attractive returns over the years ahead. The journey of investing is a marathon, not a sprint. These 4 bets represent years of accumulated knowledge and analysis. They represent my best thinking about where value exists in today's market, and they represent my confidence that patient, concentrated investing in quality businesses remains the surest path to building lasting wealth. Universal Music Group, Chipotle, Howard Hughes Holdings, and Alphabet. 4 companies with durable advantages, 4 companies with significant growth ahead, 4 companies trading at reasonable valuations, 4 big bets that I believe will reward patient shareholders for years to come.